Imagine working for 40 years, avoiding debt, and finally reaching that magic milestone, retiring with a $1 million portfolio and a $50,000 annual budget. You followed every rule of traditional finance. Then, 5 years into retirement, groceries cost 30% more, utility bills climb, travel gets expensive. That $1 million suddenly feels dangerously inadequate. Curious. The strange part is that no catastrophic event occurred. Your stock portfolio didn't crash, and you didn't make any bad investment decisions. Instead, a continuous, invisible force is quietly eating away at your wealth. That force is inflation. Focusing entirely on the size of the number in your bank account, rather than what that specific number can actually buy, is a fatal mistake. Financial professionals call this the money illusion. To understand how this works, we need to define purchasing power. Exactly the same year after year. The volume of goods those bills can acquire constantly changes. Think about the cost of a cup of coffee. A simple pour that cost $1.50 20 years ago regularly costs $5 today. The exact same dynamic applies to large, life-anchoring purchases. A suburban home that sold for $200,000 decades ago often costs well over $600,000 now. The property didn't change, the value of the money did. Here is the underlying mathematics. If annual inflation averages 3%, your $100 bill will purchase exactly 3% fewer groceries the following year. Even if a retirement account looks completely untouched on paper, its real-world utility shrinks a little bit every single day. Retirement is a 20 to 30-year stage, which exposes your savings to decades of compounding inflation. It is a long-term endurance test for your capital. This line graph plots John's living costs at a steady 3% inflation rate. Over time, because inflation compounds mathematically, John's baseline survival expenses curve sharply upward. By year 25, his original lifestyle costs more than $100,000 annually. Planning for today's prices without forecasting tomorrow's exponential costs mathematically guarantees that a static retirement plan will run out of money. Working adults have a built-in defense against rising prices, income growth. When inflation goes up, salaries eventually rise. Retirees, however, are largely trapped relying on fixed income sources like pensions and savings withdrawals. This fixed income collides with an unavoidable accelerant to a retiree's budget: healthcare. Doctor visits, long-term care, and prescription medications historically rise much faster than general inflation. Faced with these threats, many retirees fall victim to the cash fallacy. They instinctively hoard money in traditional savings accounts to hide from stock market volatility. Earning 1% interest in a bank while inflation runs at 4% results in a continuous, net negative loss of wealth. Hiding money in a vault to keep it safe from market crashes is actually the riskiest possible financial decision because it guarantees invisible financial erosion. Success in retirement depends on shifting your focus from saving dollars to maintaining purchasing power across several decades. This requires an active strategy. The first defense is maintaining exposure to growth investments. Asset classes like equities historically outpace inflation, acting as an engine for your portfolio. This pie chart illustrates the second defense, diversification. Adding asset classes like real estate and inflation-protected securities balances out the inherent risk of your equities. The third defense is preparation. Before you quit working, proactively build aggressive healthcare and medical inflation assumptions into your retirement projections. The ultimate weapon against inflation is time. Just as inflation compounds negatively against your spending, early investment growth compounds positively to build your wealth. By recognizing the illusion of a static bank balance today, you can build a dynamic portfolio designed to afford the actual rising cost of your future freedom.